battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office. For the past 44 long years, it's been our family's mission to help deliver clarity and confidence to help secure your financial future. Thank you for being back on the show. I apologize for the delay. Let not your heart be troubled. We are back with episode 207, if you can believe it. It's week 49 of the year. Man, it just flew by, and we missed a few weeks with some of the things we had going on with events at Stenger Family Office, and then I had no voice last week. My voice is kind of coming back this week. So that is the reason for the delay, but we are going to try and hit every single week now until the end of the year. I do think Santa Claus is coming to town very soon, and what I mean by that is I think we are going to get a little Santa Claus rally here, which is very typical at the end of the year. We had a pretty normalized market this year, believe it or not, despite all the doom and gloom stories, despite tariffs, despite the panic and the sell-off in April. It's almost like everybody already forgot April, which I predicted in April. I said, you're not even going to remember this. And people were treating it like it was the end of the world. And I just took you back to COVID. And I said, don't you remember COVID when the market dropped like 35% in 2 weeks? We shut down the world. You couldn't even get on a plane. You couldn't go out of your house. You had to wear a mask and stay 6 feet away from people. And people were acting like tariffs were going to be worse than that. And I said, no, just stay on your plan. So the market literally went down 19% in April. April 7th marked the bottom of the market. That's when everybody panicked. And I think that's a contraindicator. When you get a ton of calls from your clients, and then you see Goldman, Morgan, and Merrill and all the top places on Wall Street cut their forecasts for the S&P, that's the exact best time to buy. That is the signal. That's the buying opportunity, is when everybody's bearish. This is not complicated stuff. So when I get the calls from clients and they're worried, that makes me optimistic. So right now, what's happening? Well, we get a ton of data on this because we work with about 750 or so clients now. So we know what people are thinking. We know what's going on out there. And the consistent theme is people think we're in a bubble. So that tells me we're not in a bubble. If everybody thinks we're in a bubble, that's not a bubble. And like Dr. Siegel has said on CNBC lately, bubble is probably the most overused term out there right now. And people are using bubble to describe basically all stocks that they think are about to pop, that are just overvalued. And they would look at the S&P 500 and say, okay, all 500 companies are in a bubble. And that's just not accurate. That's not true. This is clickbait. So you've got to be able as an investor to distinguish between clickbait and actual reality. And the reality is based in data. It's literally that simple. So if you've been following the show now for a while, we've even got the Morningstar hat behind me on the bookshelf. Morningstar is the big data provider. I love this hat that they gave me at a conference I attended. And it says, I love data. We love data. Why? Because data is what keeps you grounded when we're going through an abyss. And that's where we're at today. People are so fearful. They're so rooted in this idea that we're in a bubble, that the market's a fugazi-wazi. There's no way that we could be at this point. And they're missing the broader picture. And they're missing really the underlying fundamentals. If you saw the Black Friday shopping numbers, it was off the charts. We had a record high Black Friday shopping. And by the way, if we matched last year, that would have been good enough because everybody predicted we were going to fall off a cliff. People aren't going to spend money. That's just not true. People are out there. We are spending money. And I am in the economy. I'm watching what's going on. I see restaurants. Restaurants are still full. Travel is full. Airplanes are full. Everybody's going to Europe still over the summers. And so I think you're going to see the S&P continue to make record all-time highs. And we may not get 20% years every year. That's the other thing I see. People are used to these 20% years. The annualized return now for the S&P the past 2 years is about 20% a year, 2.5 years. These are unseasonably high numbers. You should not be expecting 20% a year. So if you get these 20% years, what do? You're happy for them when you get them. You don't rely on them. You don't build your financial plan off of expecting 20% forever. You build your plan off of 7 or 8%, somewhere in that zone. And so you're happy when you get the 20s. But if we come out next year, and I told this to one of our clients, I think it was last week, I said, I think we're going to get 8 to 10% next year in the S&P, like I've been saying on the show. And he's like, oh, only 8 to 10%? Really? I'm like, yeah, but your expectations are way too high. You're expecting 20. You're not going to get 20 forever. Now, if we do get 20, consistently year after year after year, you should be worried. That's what happened in the melt up in the 90s, 92, 93, 94, 95, 96, 97, 98, all those years leading up to the tech bubble. The market ran way past where earnings could support. We were getting 20, 25% returns annualized with no end in sight. And eventually the bubble popped. It was a bubble in the 90s. Why? Because the general S&P was trading at 44 times earnings. You had stocks like Cisco trading for 200-300 times earnings. You had Pets.com, zero earnings, just trading on eyeballs, on screens. Oh yeah, cash flows and revenues and profits don't matter anymore. It's just eyeballs. So if you start hearing that stuff, that's a bubble. And by the way, I would actually argue that we had a mini bubble. If you want to use the term bubble, we almost had a mini bubble in 2021. The Fed cut rates down to basically nothing during COVID, and there were stocks that traded 200-300 times profits or traded at astronomical levels that had no profits, and those stocks all popped. So if you're waiting for this bubble to happen, you've already missed it. It happened in 2021. When the Fed started to raise rates in 2022, then the market went down, but these stocks already got punished heavily the past couple of years. So the idea that you're waiting around for this massive, massive market meltdown, and you're just you think there's doom and gloom lurking behind the corner every step of the way, you are going to be waiting a very long time, in my opinion. And I'm going to have people who disagree with me, and I've got people in the comment section on YouTube. There was my favorite comment 2 weeks ago was somebody said, you look like you're 16 years old. You don't know what you're talking about. To which I'm like, thank you so much. That is the nicest thing anyone on YouTube has said to me so far. I was getting some gray hair here thinking I look like I'm like 40, but you think I look 16. Thank you. That is so nice. I'll take the compliment. But, I'm sure people are going to roast me on YouTube on this. They're going to say, oh, you don't know what you're talking about. You've got rose-colored glasses on and you don't know what can happen and all this stuff. And you should be more worried about the future. And guess what? They've been wrong for years. In fact, if they had been alive for 200 years, they would have been wrong for 200 years pretty much as an investor. And we would have been right. The best move the past 40, 50, 100, 200 years has been to be an optimist, to be a bullish person in the market. And the reason for that is every single one of these companies is run by real people. Now, if I go out and I put a show on YouTube and I say, the world's coming to an end, here's the 10 reasons you should panic out of stocks, we'll get like probably 1 million views. Everyone's going to be like, oh, that's so smart. That's so brilliant. You're so wise beyond your years. I'm sure that's what the reaction would be. Well, we're not going to do that because, first of all, I don't think that's true. But second of all, just be careful with the bears. And that's the whole point of this show. Bears sound smart. There's a saying, I can't remember exactly who you can attribute this to, but there's a saying that bears sound smart, but bulls make you money. That's the key. Bulls actually make you money. Now, it sounds kind of cavalier to be bullish. It sounds kind of reckless, or it sounds like you're not really paying attention, or you don't really, you're not managing risk properly for some reason, or it just sounds like you're not really watching things to be bullish. And when you're bearish, it sounds really smart. And some of the smartest people out there with PhDs and MBAs and CFAs and all the different letters behind their name and accolades and all this stuff, and Nobel Peace Prizes sometimes, have been wrong consistently for years. So what's the better way to be in the stock market? You'd rather be right and make money. And that's the reality of being bullish is, we, as bullish investors, we maybe don't sound as wise as the bears who will tell you the world's coming to an end. But as bulls, we've made clients a lot of money. So the results speak for themselves. You've got the guy from The Big Short, Michael Burry, who had like $150 million in his hedge fund, which in the world of hedge funds is basically a rounding error. You're basically zero. He has been so wrong for so long now, coming out of 08 and 09. He had to close his hedge fund down. And then the tweet he puts out, he says, I'm closing my hedge fund, Cyan Asset Management or whatever. And the reason is because my view on asset prices and valuations is out of whack with reality or something. What he's admitting is he messed up. He goofed up for 15 years. So, it's one thing. Okay, let's say you perfectly called 08 and 09 and you were spot on, and Netflix calls you up and they're like, hey, we're going to do a book tour. We want to do a show. You're going to go on a book tour. Barnes and Noble's wants you signing books in their store. Netflix has got a special on you. They make The Big Short. You're a hero. You called it. You nailed 08 and 09. Okay, great. Well, guess what? If you were bullish, you didn't call '08 and '09. You rode that market down. At one point, the S&P was down 60% in '08 and '09, 60% from top to bottom. So if you had $1 million at the beginning, you had $400,000 at the end. That's not good. That was a really bad market environment. We lost probably 4 or 5 clients at the time that got out and panicked at the bottom, by the way, never to return to the market. And we know that now with all the history. Looking backwards, these people never get back in. And you would have looked really, really bad as a bullish person in '08 and '09. You would have looked like you didn't know what you were doing. And you would have looked reckless. But guess what? If you just held on, if you didn't panic, if you didn't sell, 09, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20 years later. Okay, now 20 years almost of history, looking backwards, you would have been right just to stay on your plan and not do anything. So when you call me, and I want you to call me if you're worried, because that's what we're here for. But I'm going to tell you the same thing I'm going to tell you right now, which is stop looking, stop panicking, and stop pulling up your Schwab app every 2 seconds. That is the reality of being an investor. Now, this is how you have to think as an investor. If you want to really get good at investing, and you have to reframe your mindset. You've got to think about your public equities like as if they were private companies that you actually managed yourself. So I'll give you an easy example. Like Stenger Family Office here, we're a privately held company where we have LLC, and we've got our revenue and our expenses and our clients and our our team and our people and real estate and all the rest of it that goes into running the business. And the only thing that I care about running Stenger Family Office, and if you talk to Julia, who's our head of operations, and Bond and Sam and all the rest of the people at our firm, if you ask them what they're worried about, the only thing that we talk about on Monday meetings that we get on is about our clients. We talk about client cases. We talk about the business. We talk about how do we make sure we deliver value to people? How do we make sure we do a good job on the portfolio? How do we do a good job with financial planning? We go around the room. We talk about everything. That's what we care about. I don't think we've ever had a discussion of, what's Stenger Family Office? What's the value of Stenger Family Office? We have never discussed that once. And I would bet you, because I've got clients at large Fortune 500 companies who are pretty high up, high level people, I would bet you they're the same way in their board meetings. And I've asked them that question. I say, do you ever talk about the stock price? Maybe a little bit, talk about, benefits and where the stock price is at in relation to that. But how much do you really care about the stock price? Not really that much. You care about, if you're ExxonMobil, you care about getting oil out of the ground. If you're Procter & Gamble, you care about making toothpaste. If you're Home Depot, you care about how many people are coming into your store and buying 2x4s. That's what you care about when you're running a company. You don't really think about your company's stock price per se. So that's how you have to think about your equities. And so it's no different if you were running a little Greek restaurant here and you were bringing in customers and serving them food and making them making a pita sandwich. Okay, it's no different. You got to act like your public equities are just like privately held businesses. And if you talk to any business owner, they don't care about the value of their company until they're ready to sell. And that's the only time as an investor that you should ever think about the value of equities. The only thing you should worry about long run is the fact that these companies are delivering shareholder value. They're creating products and services people want, and they're taking care of their customers. And over time, if they take care of their customers, that will ultimately take care of their stock prices. That's what you care about as an investor. So when you see Amazon go down 75%, which happened in the 90s, by the way, Facebook, not that long ago, everybody forgot this, 2022 went from like $200 a share to $90 in the blink of an eye. Took like 6 months. It went down an incredible amount and lost a ton of value in the short term. When this happens, you first of all have to be prepared for this mentally. You have to know it's coming ahead of time if you're going to buy equities. And if you're not prepared for that, don't buy equities. If you aren't ready for a 20, 30, 40% pullback, even a 60% pullback, do not be in the stock market. You can't handle it because that can happen. But what happened with Facebook, for example? Well, Facebook got dirt cheap. And again, you looked at fundamentals like we did at Stenger Family Office. You realized Facebook was trading 12 times profit. It was basically a value stock with a 30% growth rate. So what did you do if you were smart when Facebook was at 90? You loaded up on Facebook, and now it's almost a $700 stock again. It got up to almost 800. So that's how you have to think of investing. You do not care about the value of equities until you're ready to sell. What do you care about? Cash flows. That's why you have to watch what you're buying. Make sure they produce good cash flows. Make sure the cash flows are coming from actual operating activities and not fancy financial footwork in the background. So that's our job at Stenger Family Office, is to make sure that you would be in the right equities, the right companies that are producing dividends and buybacks and increasing earnings over time, so that over the long run, the portfolio is going to go up. And if you add all this up and you say, we're going to have a 3% inflation rate, we're going to have a 2% buyback yield, 2 or 3% dividend yield, 6% earnings growth, that's why equities, you add all that up, that's why equities go up about 10% a year. And so next year, if the S&P is at 7,500, like I keep saying I think it's going to be, don't be surprised by that. It's not going to be a bubble at 7,500 either if the earnings come in where analysts expect. And by the way, all the analysts are bearish too. They all always produce lower than expected numbers because the companies are also, to go back to an earlier point I was trying to make, the companies are also run by people who are nervous in the service, as my grandpa Jack would say, and worried about the future, just like all of us would be. And they're being conservative when they publish their estimates. So why is it the companies beat earnings estimates like 86% of the time or something like that? Well, because they already bake a conservative estimate into what they tell Wall Street. So this is why the market goes up over the long run, because companies are working at this. And if you talk to the heads of Home Depot or Procter & Gamble or AT&T or Walmart or Amazon or Microsoft, any of these companies, they sit down every single week and they're worried about all the same stuff that you and I are worried about. They could list out 15, 20 reasons of why you should run for the hills and panic and buy gold and all that stuff. But they don't do it. They just go to work and run their companies. So as long as that's happening, which has happened again for 200 years, and back to Ecclesiastes, nothing new under the sun, you should just stay on your plan, just like these management teams are. So that's my message to you today, is the bears sound smart, but in the long run, bulls will make you money. And that's what really matters, is that you would be in a portfolio that's going to be diversified. It's going to have risk management built in. You've got rainy day money. You've got treasuries to cover maybe 3 to 5 years of living expenses. And then everything else is in the equity market. So stay on your plan. I'm going to keep encouraging you, stay on your plan. I do think the most recent correction was probably the last big one for the year. I think we're probably going to see a small Santa Claus rally. And if we do, I'll bring out the Santa suit, I promise. Maybe we'll bring Ebenezer Scrooge back on like we did last year. That was a fun episode of Bullish. But just stay tuned. We're going to have a pullback probably next year. And I would guess it's going to be a 10% pullback. If you've got $2 million, that's $200,000. If you got $10 million, you get a 10% pullback, that could be $1 million. You could see $1 million wiped off the portfolio like that. And by the way, if we get a 20% pullback, you just do the math. It could be hundreds of thousands of dollars depending on your portfolio size. And what I want you to remember is that I told you on this episode 207, it's December 3rd, 2025, it's coming. The correction is coming at some point, and it's not the end of the world. It's not the time to run for the hills and sell everything. You know it's coming. And if you got cash, put it in the market. Every single one of these pullbacks ever, every 10%, 5%, 20, 30% correction ever, every single one of them's been a buying opportunity, and you ought to be buying when everybody else is panicking. Thank you so much for being on. I hope you had a wonderful Thanksgiving. Thanks for being on the show. We'll see you again next week for episode 208.